Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, July 18th, and you're tuned in to On Trend. So today we're going to look at the state of the market. I'm going to show you my breadth tables based on the indexes and sectors and show you my objective way to measure the bullishness or bearishness of the broader market. All right, so we're going to start with the S&P 500 because it, of course, is the 800-pound gorilla in the room. We're going to get to small caps in a little bit, and I know that small caps are lagging, and a lot of people think that small caps are the canary in the coal mine, but really the S&P 500 is the stock market. All right, it covers 80% of the total investable U.S. equity market, and it is the main driver of stock prices. And if we get a downtrend in the S&P 500, then we've got some serious trouble. But right now, we don't. If you look at where the market is, if you go to a year-to-date basis, here we are 1 year ago in late July 2018. And so we were around 2,800, and now we're just below 3,000. So we're up on a year-to-date basis. We hit 52-week highs there in May and again here in July. So the long-term trend is up, 20 days above the 200-day. The only negative that you can see here is that we've had a pretty sharp advance from, say, 2,750 to 3,000. And so that suggests we're going to get, or we're ripe for a correction. I mean, corrections are perfectly normal. And so for some correction targets, I'm going to turn to SPY, and we're going to also look at QQQ and IWM. Now, just to put things into perspective, I've got three charts here. This is SPY, and it is unadjusted. It doesn't include dividends, so that means it's going to reflect the S&P 500, which also does not include dividends. I got the unadjusted S&P 500 equal weight ETF to show you how the average stock in the S&P 500 is doing. And then I've got IWM here in the lower window. And the most important thing is that we have new highs in SPY and RSP. Now, I know some people are going to say, well, you know, we're breaking above this high and now we're coming back. That's a failed breakout. Well, I'm not buying that argument because we made the higher high. As I showed you before, the 20 days above the 200-day. So the moving averages are in order. We're well above the 200-day. So, you know, we made the higher high. If we zigzag and move back below it, I don't think it's a big deal. When do we have trouble? Well, when we start breaking support levels here. You can see if we go below 100, we're going to break a pretty big support level. And then you can see here for SPY, we have that support level around 272. But the big difference, of course, is IWM. All right. It's like 12% below its 2018 high. In addition, it didn't even make it above the May high. So small caps are really lagging, but keep in mind that small caps account for less than 10% of the total U.S. investable equity market. So here's SPY, and in order to estimate a target for a pullback, we're going to look at three things. All right, first of all, we have kind of these broken resistance levels that could turn into support. So from the highs in 2018 and in April. So that's the first area to watch. Second, you can see we've got a little low there from June. So that's another area to watch. So we have a support level based on a bounce. And then third, and actually there's four, we've got a 38 to 50% retracement. And right in between that retracement is the 50-day moving average, the dotted line. Now note that I only use the 50-day when it comes to the S&P 500 and SPY. I pretty much don't use it for others, index ETFs or ETFs or stocks, because it doesn't work as well. But so many people watch it for the S&P 500 that it does tend to work better for the S&P 500. Because you can look back here and you can see for SPY, we broke below the 50. We failed here. We got above it one day, but ultimately failed. And then you can see, and that was a 200-day as well. But you can see we're holding the 50-day on the way up here, and then we start breaking it and weaken, and then we get above it, and we're doing well. So if we break the 50-day, that might be more of an opportunity than a threat. All right, you get down into that 285, 287 area, and you get RSI below 30. I'm using RSI 10 here. And then you've got maybe an opportunity for a mean reversion trade. So, my zone is just like this 288 area, give or take 3 points. It's hand grenades here. We're not doing a target practice with a 22. We're looking for a zone, not a pinpoint level. Now, if we look at the Nasdaq 100 ETF QQQ, we can see a potential zone there around 182.5. So I'll call it 182 to 185. So that's a 38 to 50% retracement. You can see a little bounce low there, marking support as well. Yeah, I don't really have a resistance level to mark, but that's kind of an area to watch. And if RSI gets below 30, then we'll be short-term oversold. Sometimes you get these double dips. If you look at May, there we got a double dip with a second move below 30 in June and then the breakout in early June. So, it could be one of these dog days of summer where we go down into July and the middle part of August and get a double dip. And then maybe we get the famous late summer rally. But we'll take it one day at a time. But right now, I think a correction that retraces 38 to 50% of these ETFs indexes would be perfectly normal. 38 to 50% of the June advance. Now, small caps, now this is a different story. All right. And the different story is small caps remain bearish. We had a bearish failure swing there in May, and that was pointed out in the Chart Watchers newsletter in an article that I wrote. And that signal really remains in play. Now, keep in mind, a bearish failure swing is independent of price. All right. It forms when you get a move above 70 in RSI, a dip, and then you get a bounce in RSI that fails to go above 70, and then you get a move below the intermittent low, which we got there in May. So that's like RSI is trending lower, basically. And if you look on the price chart, you can see we've got a lower high from August 2018 to April. And whereas SPY moved above its 2018 high and that early May high, IWM did not. It's got another lower high working, and you can see we just broke that trend line with the decline yesterday. Now, am I interested in shorting positions? Not really, because as long as the S&P 500 remains in bull mode, it could be more of a choppy correction. Keep in mind there are two ways to correct. You can either move sideways or you can decline to retrace a portion of the prior advance. And sometimes you do a little bit of both. You kind of just zigzag or chop lower, and that's what we could see. So now let's look at the state of the market from an objective standpoint. What I mean by objective is, we put our rules in place and then we act according to those rules. When we get signals based on those rules, we accept them and we trade accordingly. Now, what I've done is I've set up a breadth table using the small cap, mid cap, and large cap indexes, and a breadth table using these sectors in the S&P 500. And I use the weight of the evidence from those breadth tables to say if I'm bullish or bearish. And these indicators have been net bullish. I'll show the table in a minute, but I'm going to go over the indicators first. And this is updated every Friday to give you an idea of where we are in the market, the state of the market. And it's based on 9 indicators. So the first 3 are the percentage of stocks above the 200-day EMA. And we do that for the S&P 500, the S&P Mid-Cap 400, and the S&P Small Cap 600. And I've got a bullish line at 60%. So when you move above that level, which we did way back before this, and as long as you stay above 40%, you don't have a bearish signal. But then in October, all 3 moved below 40%. So that showed enough critical mass of selling pressure to turn bearish. And then you can see that the indicators turned net bullish on February 15th when 2 of the 3 had already moved above 60%, and actually 3 of the 3 by mid-February. But then that signal reversed because the S&P 500 held above 40% in May, but you can see the mid-cap indicator moved below 40%, and you can see the small cap indicator triggered in March. So fast forward, 2 of the 3 were net bearish at the end of May, and they remain net bearish. So you can see mid-caps here didn't move above 60% to give us a bullish signal there. Now, the other indicator group is used to measure a breadth thrust, and it's usually one of the first indicators to trigger. And if you look here, you can see on January 10th, we got a breadth thrust from all 3 when the 10-day EMA of 80% moved above 30% for all 3 indexes. So there we can see that move above 30% in early January. And that signaled a strong upward thrust in upside participation, and that is very bullish. And it stays a bullish signal until we get a move below minus 30%. And we haven't gotten that yet. We touched 30% for small caps down there, but didn't trigger. So these 3 indicators remain bullish. And then the next indicator group is high-low percent. And this is the highs minus lows, net new highs, divided by total issues. It's the percentage of net new highs. And what you have here is when you have a move below minus 10%, that shows enough strong downtrends to suggest a bearish environment. And all 3 of them triggered there in October. And then we had the S&P 500 triggering in mid-February, and finally mid-caps triggering in early June. But small caps are lagging because this indicator has yet to reverse its initial bearish signal from October. So 2 of the 3 indicators here have been net bullish since June 12th. So now let's sum these all up and show them on a nice little table to show you how I get my objective state of the market. So here is the broad market overview for the major indexes and their breadth indicators. Now, first of all, for the S&P 500, the 20 days above the 200-day. Okay, so that's another indicator that I use. I don't use it for the other indexes, just the S&P 500. Now, when we look at these breadth indicators, we can see that 2 of the 3 indicators were bullish for the S&P 500 as of February 5th, and all 3 were bullish as of February 15th. All right, then we look at the mid caps, and we can see 2 of the 3 are bullish since June 7th, but we still didn't get that percent above the 200-day turning bullish. And you look at small caps, 2 of the 3 indicators are on active bearish signals. And then what I do is I sum them all up. And basically, the indicators as a group, 9, at least 5 have been net bullish since February 15th. So that means we've been net bullish for March, April, May, June, July, 5 months. So this is not a signal, hopefully, that you're going to get every week. It's a signal that I'm looking to give you the path of least resistance for the broader market. Now, small caps, the path of least resistance has been down since March 2018, and that's reflected in the charts as I just showed you. So before we look at the sector chart to see the weight of the evidence within the S&P 500, I want to show you one chart with the 3 breadth indicators. And this is for XLE, the Energy SPDR. So first we've got the 10-day EMA of 80% for XLE, high-low percent, and the percentage of stocks above the 200-day. And the same signals apply. You get the move above 30%, that's a bullish breadth thrust. And you get the move below minus 30%, that's a bearish breadth thrust. You get a move below minus 10%, that's bearish for high-low percent. And you can see we don't have a bullish signal since that bearish signal. You get a move above 60%, that's bullish for the percentage of stocks above the 200-day. And you get a move below 40%, that's bearish, as we got there in early May. Now, the reason I don't put my signal lines at that middle line, 50%, is because you're going to get too many whipsaws. I prefer to have a buffer so I get critical mass on the upside at 60+%, critical mass on the downside 40% or less. So if you have 40% of stocks above the 200-day, that means 60% are below the 200-day. So if you look at XLE, we did have a bullish signal there in April, but it was quickly reversed in early May. So we'll get whipsaws. Nothing is perfect, but this one has been on a bearish signal. And after the breadth table, I'm going to show you that we are reversing at a bearish reversal alert zone for XLE and oil. Now, as far as I'm concerned, it doesn't matter which sectors are leading the market. It just matters that the weight of the evidence, in other words, 50 plus 1% of the sectors are bullish. All right. If 49% are bullish, then that means less than 50%. So that means we have a wobbly market or maybe even a negative market. And so the way I do that is I take these same three indicators for the 11 sector SPDRs. And there you can see I've got the sector weight here on the left. And I've got the number of bullish signals here. You can see 3 of 3 for technology, healthcare, and finance. Consumer discretionary has 1 bearish signal. Energy has 2, that's why it's net bearish. And materials has 1. So I multiply the weighting of the sector by the percentage of bullish bearish signals. So this would be 100%. So you get 21.5% plus on this one. You can see that energy is 2/3 negative. So 2/3 of the weight there, 4.91% negative, is 3.27%. And then you can see XLY has only 2 bullish signals. So 2/3 of its weighting, 10.29%, is 6.86%. So I take these and I add them all together, and you can see I've got 87.5% for my bullish weight. Now, this is not like an allocation formula. It just tells me the net bullishness, net bearishness within the S&P 500. And so if this goes below 0, this number, then we have a negative or bearish market environment. All right, but it has been bullish since early February. And what I can do is I can sort this column or this table by the date of the bullish or bearish reading. So I'm going to go to data and I'm going to sort that. And I want to sort by the column there. We'll call it column J. And I want the oldest to the newest. So there we can see how the signals rank and when they occurred. Utilities had been bullish since June. And there we can see in January, we started getting, June 2018, by the way. And in January, we started getting bullish signals from REITs. We got healthcare, consumer staples in January. February 1st, we got technology. And February 5th, we got industrials. So by that time, February 5th, we had the majority of sectors, 7 of the 11, on active bullish signals. And if you summed up the weights, it would have been positive on this table here. And so the S&P 500 has been bullish since the early part of February, and it remains bullish. I don't know how long a signal will last. I don't know when it will reverse. I don't know how far an advance might extend. I'm a trend following kind of guy, and I accept the trend and I follow it until proven otherwise. And this is one of my main methods for the S&P 500. So note that I update this table in a written commentary every Friday. I'm going to start doing the video on Thursdays and including it on trend. The Arch Charts commentary is not part of the paywall anymore, so anybody can read it. And you can see the Arch Charts postings on our main blogs page. And even though it's in green, anybody can read it. And you can also go to the Arch Charts link here on the right-hand side. And it says members only, but we put it outside of the paywall for now. And there is the state of the stock market. And you can see this table every Friday to get an idea of where we stand as far as the stock market is concerned. And there's the table. All right, so now I'm going to show the sector charts, and I put them in an order of how I think from strongest to weakest. Now, I don't think you have like a definitive number 1 or a definitive number 3, definitive number 6. They kind of go in groups. All right, you have your strong group at the top, maybe 5, actually 5 this time. You have this kind of in-between group in the middle that's not really relatively weak, but clearly not a leader. And then you've got the clear laggards, or the laggard in this case, which would be energy. And I've also got industrials and communication services as laggards. So we're basing this on 3 things. First is, where are we in relationship to the 2018 high? And you can see consumer staples is well above that high, and it broke above that high. And also, where are we relative to the spring highs and the June high? And you can see we have higher highs there. We're above the spring highs. The June high is above the spring highs, and the July high is above the June high. So this is a strong sector. And the third thing is 65-day RSI, which is around 3 months, is well above 50. It's at 58.34. So keep these 3 things in mind as we move down. So here's XLY, and there you can see there's the 2018 high, and we broke above it. There's the spring high, and we are above it. So we're making higher highs. And then you see 65-day RSIs at 57.83, a little bit less than consumer staples, but well above 55 even. Then the third one will be technology. These are by far and away the top 3. So there's the 2018 high. We cleared it there. And then you will see we cleared the spring high there in June. And we've got a higher high from June to July. And then we have RSI at 57.15, well above 55. So now we move into the second tier of the strongest ones, and that would be utilities and REITs. And the reason they make the second tier, and note that I'm using unadjusted data. I'm not including dividends. All right, I just want to know about price action. I don't want to know about the dividends added back. And if you look at just the price action, you can see, well, we haven't cleared that June high. And the first 3 cleared the June high. We're above the 2018 high. We're above the spring high, so +1, +2. But we're not above the June high, so that's take off half a point maybe. But we're clearly in an uptrend, and RSI is above 55 for utilities. And then we look at REITs, and we have a similar picture here, in that, you're above the 2018 high, you're above the spring high, but you didn't get above the June high. And this is just a minor issue right now. And RSI is at 55, basically. So those are the 5 strongest sectors easily. And then we get into ones that, they showed some relative strength in July, June, but overall, they're not that strong. They're kind of in the middle. And that's finance. I'm not that impressed with finance. There's the 2018 high, not even close. There's the spring high. We got above it, but we're back below it. All right, so that's a neutral, if not negative. And then you can see RSI's at 53.60, below 55. Then if we look at healthcare, we can see here that we're still below the 2018 high. We did get above the February, March, April high, but we're kind of consolidating here. And you can see RSI's at 52. It's below 55. So these 2, they're not that great. They're kind of in the middle. Same with materials. They're clearly not as strong as the first 5. Same thing. There's a 2018 high. We're below it. We did get above the spring high, but we're kind of messing around in that area. And RSI is below 55. Now we get into the ones that are in the weaker half. All right, and this is industrials. And I'm using these benchmark highs again. So look at the 2018 high. No, we're below it. Look at the spring high. We did not get above the spring high. So in that regard, industrials are lagging. And you can see a support level there. And if we break below 76 there, that's going to be a bearish development for industrials. And coming on top of a couple of lower highs, That's quite negative for the sector. So I'd avoid this sector. Communication services, it's not one of my favorite sectors. There's not that many stocks, like 24. You got Google and Facebook. But there's the 2018 high. Nope, not above it. There's the spring high. Came up to it, but didn't exceed it. So that's 2 strikes against it. And RSI is above 55, so that's strong. And that's probably because, that was a pretty powerful rally. But still, it's not my favorite sector right now. It's in the bottom half of the group. And then we get to clearly the weakest sector of all, and that is energy. And I've got a reversal alert zone to show you. But, there's the 2018 high, well below it. There's the spring high, well below it. Talk about some serious underperformance. And then you can see RSI is below 50. And it's been below 50 since the latter part of April. So this is why I'm negative on energy. So another reason to be negative on energy is we hit reversal alert zones in XLE and West Texas Intermediate and are breaking down. And what is a reversal alert zone? Well, there's a bullish one and there's a bearish one, and I'm going to show you the bearish one. But it's based on the premise that you have a really sharp decline that looks like an impulse move lower. And an impulse move lower means it's in the direction of the primary trend. And so this move that we get subsequent to that impulse move is a correction or a bear market bounce. So first thing, impulse move down, bear market bounce assumption. So then we start looking for where we might find resistance. And that is based on a couple of things. First, you can see those 2 highs there become resistance. So that's the first thing. Second, you can see that we retraced around 61.8%. So that's typical for, say, 2 steps down and 1 or a little over 1 step back up. And I didn't draw a rising wedge because that trend line's too steep. But you can see we started to get our breakdown there in April, May. We got the bearish breath signal. So that's the bigger bearish reversal alert zone. And then the smaller one is we got another impulse move lower. And then we got a bounce. And you can see resistance from that May high. We're in that retracement zone, 50 to 62%. So that's the reversal alert zone. And now we're breaking down. So I think this is bearish for energy. And then if we look at West Texas Intermediate crude, we see the same thing. All right, we have the big move down, the bounce, the first big reversal at the reversal alert zone. And then we had another big move down, a bounce. And there you can see broken support turning into resistance. And there's resistance around 60. And this bounce retraced around 61.8%, 2/3. And now we've got a sharp decline. And it looks like we're poised to break support and continue lower for energy. All right, so that concludes this edition of On Trend. Thanks very much for tuning in and have a great day.